ISM Services just confirmed the biggest problem facing the economy. For months, I've been saying this isn't a recession story. It's an inflation story. And today's ISM Services report may have just confirmed it. The headline looked perfectly healthy. Services PMI came in at 54.1, marking 25 straight months of expansion, while the US economy has now expanded for 74 consecutive months. Business activity accelerated sharply. New orders accelerated. Consumers are still spending. On the surface, everything looks fine. But when you dig into the report, a very different picture begins to emerge. The number that matters most isn't PMI, it's prices paid. That index jumped from 67.7 to 70.3, climbing above 70% for the fourth time in 5 months. Now combine that with yesterday's manufacturing report, where prices paid came in at 71.1. Think about what that means. Both the manufacturing economy and the services economy are experiencing elevated price pressures at the same time. This isn't one sector. This isn't tariffs alone. This isn't supply chains. Inflation has become broad-based across the economy, and that's exactly where the Federal Reserve gets trapped. Cut rates? You risk reigniting inflation that's already proving stubborn. Raise rates? You put additional pressure on an economy that's beginning to show cracks. Because here's the second number everyone should be watching. Services employment fell back into contraction at 47.4. It has now been below 50 in 12 of the last 18 months. That means businesses are still growing, but they're hiring fewer people. Even more interesting were the comments from respondents. One company wrote, "We're seeing a small reduction at the moment, some coinciding with AI implementation." Another said, "Lower employment in the US, higher in India and other low-cost geographies." That's not a normal business cycle, that's structural change. Companies are using AI to become more productive while moving routine work to lower cost regions. Productivity improves, employment softens. Meanwhile, demand for AI infrastructure continues exploding. That's one reason manufacturing remains so strong. Every AI data center requires enormous amounts of semiconductors, power, networking equipment, memory, cooling, and massive amounts of copper. Even this report continues mentioning shortages of memory components, technical labor, switchgear, and wire and cable. Those aren't random shortages. They're exactly what you'd expect during an AI infrastructure build-out. That's why I've continued to believe this isn't simply an AI software story, it's an infrastructure story. The companies supplying chips, electricity, transmission, networking, and industrial metals are still seeing long-term demand. The report also mentioned that petroleum products, fuel, and transportation costs continue moving higher. Energy inflation isn't disappearing, it's simply changing form. That becomes another problem for the Fed. Because energy works its way into almost every part of the economy: transportation, construction, manufacturing, services, food, almost everything. Now let's talk about precious metals. If inflation remains elevated while employment weakens, investors begin asking a very different question. Not how fast can the Fed cut, but what happens if real interest rates start falling later while inflation remains sticky? Historically, that's been an environment where gold and silver often attract attention as stores of value. They don't produce income, but they have frequently performed well. When investors become concerned about persistent inflation or the long-term purchasing power of fiat currencies, Bitcoin enters a similar conversation, not because today's ISM report is immediately bullish for crypto. It isn't. If weaker employment eventually creates a risk-off move across markets, Bitcoin could experience volatility alongside other risk assets. But if the economy ultimately forces the Fed toward easier policy, while inflation remains elevated, many investors could once again look towards scarce assets, whether that's gold, silver, or Bitcoin, as potential hedges against currency debasement. That's why the next few data releases matter so much. Friday's non-farm payrolls report, inflation data, wage growth, oil prices, each one adds another piece to the puzzle. Because right now, the economy is still expanding, businesses are still operating, consumers are still spending. But inflation refuses to disappear. Employment is beginning to soften, and AI is fundamentally changing how companies hire. That's not a normal cycle. It's a transition. The market is slowly realizing we may be entering an economy where productivity rises, AI investment accelerates, inflation stays stickier than expected, and the Federal Reserve has fewer policy options than at any point in years. That's why I think today's report was far more important than the headline suggests. The story isn't that the economy is slowing. The story is that it's changing. And if that's where we're headed, the biggest winners and losers over the next several years may look very different from the last decade. If you enjoy breaking down macro data without the hype, subscribe to the channel, leave your thoughts in the comments, and hit the notification bell. I cover the data as it comes out and focus on what it could mean for markets, policy, and long-term investing. Thanks for watching, and I'll see you in the next one.